Hi, good afternoon. My name is Hendrik Bartel. I'm the CEO and co-founder of Truvalue Labs. Truvalue Labs is a technology company based in San Francisco. So I came in last night. I made it in by a hair with all the storm and have been marveled by all the snow coming down today. So I'm here to talk a little bit about technology and how technology can help and progress us really with all of this impact investing and responsible investing and sort of figuring out risks that are hidden or that are not seen at this point, and make us, in the end of the day, better investors through different data sets, through different information that we haven't seen before. So I have a number of slides. I don't want to bore you with too many slides. If there are questions, I don't think there's an official Q&A after this, but I'll be floating around and happy to answer any questions. So as we've heard from a number of speakers before, we are sort of in the middle of a megatrend tsunami, if you will. There is ESG, environmental, social, and governance. There's sort of the bend into impact, but I really want to talk about ESG as it measures more risk rather than sort of an outcome. So ESG, undeniably, massive mega trend out there right now, and we'll look at some of the numbers and why that is. Then another mega trend, obviously, is big data. You all have heard about big data for the past, I don't know, 4, 5, 6, 7, 8, 9 years or something like that. IBM has been talking about big data. There's lots of studies out there how fast data is growing, and I'll look at that a little more as well. Excuse me. And then lastly, we'll look at the megatrend of AI. And sort of AI is this umbrella term of very different technologies. There's sort of not like one turnkey AI that you put into a computer and sort of say, OK, AI this, and then stuff just starts to happen. AI is sort of an umbrella term that looks at very different, I sort of say it's modern day computing technologies, something that has been there for a while or so and is now commercial grade enough where one really can use it in commercial applications. So that's what we'll be looking at and sort of why these things are here right now. So obviously ESG investing strategies are in demand. We've heard this from Naveen earlier today. We've heard this from Bank of America. We've heard this across the board that ESG is very much in demand. There's different reasons why. Sort of there's the millennial wave that's happening. There is the belief that long-term investments are much better for value creation. There is the new world data that's out there, unstructured data, which is part and parcel of big data. And then lastly, really the commercialization of modern day technologies that are structured or that are part of AI. I want to take one moment and sort of just talk about AI and why is AI really happening right now. Well, AI allows us to process new data that we did not have access to or couldn't process before. That's unstructured data. We, as humans, computers, et cetera, we're very used to processing structured data. Everything that is sort of either in a JSON file or an Excel file that has some sort of meaning to the computer can figure out what this is. So as soon as you start putting words in front of a computer that a human would understand, well, then a computer starting to lose its mind and figuring out, OK, what is it that you're telling me on this piece of paper? That's unstructured data. That might be a picture. That might be an image. That might be a sound file or so. Those things are unstructured data. So today we have the ability to process this data in a way that we haven't been able before. We also can process data in new ways that we weren't able to process data before. Up until, I would say, the early 2000s, into the mid-2000s, we were able to process data very efficiently in a linear way. We all heard of Moore's Law. We all heard of linear processing, linear programming, building things in a very linear way and thinking about things in a linear way. Well, that is over. We're now thinking about processing things in exponential ways, processing even more data in an even faster pace. So that is all happening right now. ESG, we've heard the number of $30 trillion earlier. The interesting thing about the $30 trillion for me is that has grown by 25% in the past two years. And that is just measured back in 2018. So we're now looking into 2019, and we're estimating that number is even far larger than what we've seen sort of in assets under management in 2018. So we're really going up to the upper right-hand curve here, very fast growing assets under management in ESG. I like this slide. This slide, in my opinion, explains a lot what we're sort of seeing out there, why ESG is in demand. This also explains what's happening with corporations in the world. So this is a slide that looks at traditional financial fundamentals as well as intangibles. So the dark bars here are looking at, the dotted bars are looking at traditional financial fundamentals of the S&P 500 constituents. If you go back 40 years into the 1970s, and sort of you think about the blue chips that were part of the S&P 500 back then, it made sense that over 80% of their financials were explainable by really just their fundamental values, the way they're manufacturing, the way they're employing, the way they're talking to the market. The interesting thing here is that has completely reversed over the past 40 years. If you're looking at the constituents of the S&P 500 today, and you're looking at the financial fundamentals, only 13% of that can be really explained by traditional data sets. The rest is explained by reputation, innovation, employee relations, data security, privacy, energy management, product quality, safety, supply chain management, all this stuff that we've talked about before in one way or another, either through sort of impact or even through the stuff that's really hard to measure, because you can really, it's hard to grasp. It's hard to sort of put a handle around it. But it totally makes sense. If you think about a sales force that's part of the S&P 500 versus an IBM or so that was part of the S&P 500 40 years ago, and how these companies changed, what matters for these companies. So this is an extremely interesting graph, in my opinion, that really pushes us to think about ESG as a risk factor much more than ever before. Lastly, unstructured data. So unstructured data is huge. It's proliferating everything that we're seeing out there. Vernon Turner at the IDC says, like the physical universe, the digital universe is large by 2020, containing nearly as many digital bits as there are stars in the universe. And it's doubling every 2 years. That's pretty scary. That is that's a lot of data. That's a lot of unstructured data, because most of this data is not written in a way that a computer can easily understand it. It's written as a blog post. It's written as a news article. It's written as a picture. It's written as a sound file. And all of this stuff now needs to go into a computer to figure out, or ask the computer, okay, what is this? Because I don't have all that time in the day to really figure out what makes sense in this kind of file. What's important? What's the important information that I need right now to make a decision? So that's what we're seeing in unstructured data today. So now we're moving over to ESG research. What's working? ESG research facilitates integration of environmental, social, and governance factors across the investment value chain. So we're looking across the value chain, not just at the company, but we're looking at all the participants, the stakeholders in the company. We're also looking at an increasing universe of issues, There are new issues that we weren't able to measure 5 years ago. There are new issues coming up every day. Companies are living, breathing things that change as dynamic as the people who work there. There's more and more companies. There's larger universe to cover. One of the first questions we usually get from a company or from an investor that wants to work with our data, what's your coverage universe? How many thousands of companies do you cover? How many thousands of different asset classes are you covering? How many different securities are you covering? So there's an appetite for figuring these things out in a very granular way. And there's more sophistication than ever in ESG research, but also in sort of using this data in ways that haven't been used before. What's not working anymore? Well, the old world is not really working anymore because, well, competitors or other investors are already catching up. They're using new data tools. They're using new ways of finding information. And this is where I sort of, usually don't talk about ESG as a separate class of measurement that you now need to look at from a ratings perspective or from an information perspective. It's just another risk factor. It's just another piece of information that you should include in your model because your competitors are doing it already in order to get a better information edge. And it's solely about information here. If you wouldn't incorporate ESG today, you're at a disadvantage because your competitors are doing it today. So models, typical ESG models today are black box. It's sort of a framework. There's a bunch of analysts looking at data telling you, okay, this is a company that's being rated X and Y and Z. Well, then what you have is sort of this correlation analysis where you have two prominent ratings companies out there in the market, and you look how they rate the constituents of the S&P 1200, and you're finding a correlation of 30%. Wow, just 30%. That's not a lot of correlation. And you're paying a lot of money for that, right? So outputs are low correlations. Timeliness of data is a big issue. Most of these ratings update once a year. So now I'm working with data that's a year old, and I'm making a decision today. Well, how's that really going to work? So we've moved from a model of scarcity to proliferation. We've seen that we're moving from structured to unstructured data into a world where we're now structuring unstructured data. We're taking unstructured data as an input and structuring it so that a human can read it in the end and not really just a computer anymore. We're moving from a primary use case of a screening, worst in class, I cannot invest in these companies, in more of a dynamic peer analysis, in something where we're seeing trends, where we're seeing how companies really work and how their momentum changes. We're moving from an annual frequency to an intraday frequency. All of this stuff can be measured today. Very quick, we've also seen the models of research change. The old world model starts with data miners and a sprinkle of technology. Sprinkle of technology might be an Excel sheet. I need to corral all of this data. And then there's a heavy analyst overhead here of really processing all of this data. We as a company, for example, have reversed this, and we've put analysts and engineers really in the front of the process to develop all of these algorithms, and then we've added technology towards the back end to really process all of this in rapid fashion. So is this really working today? Two examples here. This is Valet, early warning signs that we've seen for Valet that they have really followed a mega trend downwards over years, not just over one day, but we've seen this over quarters and quarters and quarters, and we've seen a massive spiral for Valet before even the dam exploded. Danske Bank had ethical issues sort of on some of these, on money laundering all along, but then all of a sudden the police got involved, and we've seen their stock value plummet 42% year to date 2018. We've seen our data cited. So there is correlation between this real-time ESG data, real-time risk data, and price performance data, if you will. What else can we expect from the future? So the stuff that I just showed you, it works today. This is not the future. This works today. If we sneak peek into the future just a little bit, I think what we will see very quickly here is, and I'm a big fan of that, is the measurement of actuals. Not the measurement of assumptions, not an Excel model that allows me to sort of have some data from company A, I have some data from company C, so now I can fill in the middle of an assumed value between company A and B, or A and C, that gives me B. We will see sensors, proliferation of sensors. If you have a phone, if you have a smartphone in your pocket, you already have at least 5 sensors on you right now. Everything around you will have a sensor, already has. 212 billion sensors all around us by the end of 2020. 220 billion sensors, that is 30.8 sensors per person on the planet. That is a lot of sensors to measure stuff. Adaptive and smart manufacturing are now the standard. If you're a manufacturing company, if you're a factory and you don't use adaptive or smart manufacturing technologies that have sensors throughout the entire value chain, then you're at the losing end. Then you're not compatible with your competitors. That's the G. Hyperlocal air pollution, climate emission data at unprecedented resolutions. That over there is real data. That is San Francisco. Every Google Street View car that you're seeing driving around has actually a number of air pollution sensors, can measure air pollution in real time. And that creates such a picture that actually changes daily. So you can actually see who are the emitters, and you're not just doing an assumption there. That's the E. Lastly, very quick, S, social. What about the S, the social? So all of the stuff that you see here in the background are low orbital image sensors, satellites. Satellites are the size of a shoebox, this size, super easy to put them up into space. And actually, you can steer them around like fleets. You can monitor mines. You can monitor dams. You can monitor parking lots. That's not future anymore. Most hedge funds do that. You can detect vessels. You can figure out fishing routes. You can figure out pollution in the ocean based on image divs on the color of the ocean. So all of this stuff is hitting us very, very fast in the next 2, 3, 4 years. This is not stuff that happens in 20 years. This is actually happening right now in very fast speed. Conclusion, I'm out of time. I'm 2 minutes over. The conclusion is that I ran over time, as well as the top reasons for deploying AI. You get scale. This is the most important thing. Properly deployed AI can be analogous to having thousands of your own personal research assistants. This is not waiting for the magic answer. This is really scaling up in a fast way. Making intelligent people even more intelligent, that's what it's ultimately about. The computer will give you some answers, but you need to have people who then create creative answers out of that. A computer will not give you the creativity that humans will give you. Uncover hidden risks and insights, hidden in plain sight, but buried in a sea of information. And key to success is domain experts must be tightly integrated into any AI pipeline design. So with that, I thank you very much. I'm going to take questions after, and thank you.